Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the daily high and low strategy, a systematic approach that utilizes the previous day price range and extreme to identify potential trading opportunities. You will discover how to read market dynamics through daily price levels, implementing precise entries and exit points, and you will develop a structured trading plan that fits your style of trading. Whether you are new to Forex or you are looking to refine your technical analysis skills, this strategy offers a clear framework for your trading decision. Now let's look at what Forex daily high-low strategy is. This strategy centers on two key price levels, the yesterday's highest point and the yesterday's lowest point. These levels serve as a significant markers that often influence today's market movement. When price break above the high, it signals potential up momentum. Conversely, when price breaks below the low of yesterday's low, it indicates possible down pressure. Now let's look at an example. This is yesterday's candle. This is the daily candle. We would first mark out, since this is the previous candle, I'll mark out the high of the candle and I'll mark out the low of the candle. This is the high and the low. Go to the 1 hour time frame, we'll see it clearly. Since this is the high and the low of the candle, what we are expected to note is when price breaks through on the present day, if price break through the downside, we are expected to sell the market. If price break through the upside, we are expected to buy this market. Now, to execute this strategy effectively, you will need access to a reliable charting platform that displays the daily time frame. While many traders overcomplicate their screen with many indicators, this strategy requires minimum tools. Your primary focus will be on price action and the previous day range. Now this is the previous day range. However, by adding a 20 period simple moving average, this can help you confirm the overall market direction and strengthen your trading decision. So we just need to add the 20 moving average, simple moving average, to help us know the market direction. Now let's look at the rules of how we can implement this trading strategy. Let's examine the specific rules that makes the daily high and low strategy effective for our trading. We start by analyzing the overall market direction. Look for a clear trend movement. We look for a clear trend movement where price consistently shows higher highs and higher lows for an uptrend and lower lows and lower highs for a downtrend. As you can see, this is trending to the downside. Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. If you look at this part of the market, you can see that the market is trading to the upside. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. The context helps us to avoid trading against the dominant market flow. The entry rule are straightforward. You are looking for a clear break of the previous day extreme. Now, if we have noticed the market direction, as you can see, market changed direction. It created a higher high over here, breaking the previous lower high, then created a higher low. Now we know the direction of the market. We'll mark out our our previous daily high. This is the previous day candle, this particular candle here. So mark out the previous daily high and mark out the daily low. After confirming our direction of the market currently, this is the direction of the market right now. Now let's not forget the rules are easy. If you want to enter for a buy, the entry rules are straightforward. They are straightforward rules. You are looking for a clear break. We'll go to the 1 hour time frame to understand what is really happening in that previous daily candle. In the 1 hour time frame, we would look for a clear break of the previous day extreme, either the upside or the downside. For a buy trade, we wait for price to break above yesterday's high. This is yesterday's high from the marks, from what we marked on our daily time frame. Then your entry point, if it's for a buy, your entry point should be, you would have to put your entry above, you put it 2 to 5 pips above the high where you're expecting price to break out from. You put it above the high so that you can catch the momentum of the level to confirm the breakout is genuine. This small buffer helps avoid false signals and ensures you catch the real momentum. This is for a buy trade. Now for a sell trade, you enter when price breaks below yesterday's low. Would enter when price breaks below yesterday's low. Again, placing your entry 2 to 5 pips below the level. 2 to 5 pips, you have to give it allowance so that your trade can breathe, and it is to avoid, and it will help you avoid market noise and false breakout. Now, let's talk about protecting your capital. You have to place your stop loss 2 to 5 pips on the opposite side of your entry. Let's say we are taking a trade from here. We'll put our stop loss above. You can put it above the previous lower high, lower low structure. Put it above the support or the resistance line you can see, or 2 to 5 pips below the level. This conservative approach helps you protect yourself from the market noise and false breakout. And if it's for a buy trade, below you put it below the area, either below the support or the resistance area, or below any structural point, or 2 to 5 pips below the last low, just to give your trade breathing space. Now let's not forget about our take profit. Our take profit should follow a minimum of 2 to 1 risk to reward. This means that when you are taking the trade, you should when taking the trade you should sorry excuse me this means that if you are risking 20 pips, you should at least aim for 40 pips in profit. In a strong trending market, considering you are using a trading stop, you can also use a trading stop to capture moves. But if you are to use 1:2 risk to reward, if you are risking, at least if your stop loss is at a range of 20 pips, your profit target should be at a range of 40 pips. That's 1:2 as the case may be. Or you can also use a trailing stop to capture extended moves when it has a very strong trending market. Now let's not forget position sizing is crucial. Never risk more than 1 to 2% of your account on a single trade. This rule ensures that you can withstand a series of losses while maintaining trading capital. So let's see if we can take this trade. Let's see what we can do if we want to take this trade. When we notice that price broke out from the low, our entry should have already been at this area. If we're expecting price to go down, we put our stop loss above this area too. Then we can target 1:1 or 1:2 as the case may be, and we'll see if price moves in our direction. And as you can see, price is going little by little to our direction, and it has touched our take profit. This is how you typically take the trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.